China's economic growth is gathering steam. Factory output picked up pace in the first 2 months of this year. Analysts say China's steel mills are enjoying the best profits in years, despite worries of overheated steel prices. Higher prices for steel and other industrial materials are behind the boom of factory gate prices growth for January and February. But consumer price growth cooled in the period, and retail sales growth was well below expectations. That raises doubts about China's domestic demand.
The drop in CPI growth was due to seasonal factors, as we had our Spring Festival earlier this year than the last. The core inflation without food and energy prices was 2%, a moderate level. PPI surge was due to low base effect and higher material prices for steel, coal, chemicals, and oil. Overall, the demand and supply balance in China is improving, and I think February was the highest point for PPI growth this year.
Meanwhile, fixed asset investment grew 8.9%, overshooting forecasts. 2/3 of the local governments in China have announced their 2017 fixed asset investment target. That's around 50 trillion yuan, and that's more than 3/4 of the 2016 total investment volume. Are those targets too aggressive given the fact that consumption has become China's #1 economic driver? Some analysts say no. They argue that those investments are structurally different, joined by private investors, and the growth of investments in China overall is slowing. Growth in private investment fast-tracked to 6.7% in the first 2 months from 3.2% last year, suggesting a brighter view on economy among private firms. If that momentum can be sustained, it would take the heat off the government, as private investment contributes around 80% of China's employment. Cheng, CGTN, Beijing.